Hello, I'm Jeff Benjamin, Wealth Management Editor here at ETF.com, and this is the Mid-Year Outlook. Right now, the equity markets are stubbornly bullish. Interest rates remain high, as does inflation. The Fed appears to be managing things by taunting us with potential rate cuts. There's plenty of geopolitical risk to be worried about, including a couple of wars, which at least indirectly involve the United States right now. And there's an oddly unprecedented presidential election just a few months away. We're going to unpack all of that to help make sense of it for you and your clients. And we're doing it in an hour. And you'll get one CE credit for hanging out with us. So pretty good deal. First of all, I want to introduce our panelist, Christine Soul, investment strategist at Signature Estate and Investment Advisors. Aniket Ulal, Senior Vice President and Head of ETF Data and Analytics at CFRA, and Francois Trahan, founder of the Macro Institute. Want to welcome you all. I also want to go around the horn now and have each of you introduce yourselves briefly to let our audience know why you're the best people for this panel. Christine, you want to start us out?
Sure. Thanks, Jeff. My name is Christine Soul. I'm an investment strategist at Signature Estate and Investment Advisors. SCIA specializes in non-discretionary advisory services for mass affluent and high net worth individuals. We manage about $22 billion and across 15 offices, and we are headquartered in Los Angeles. I focus on the investment positioning, selection, and direct management of client portfolios within an advisory practice at SCIA.
Okay, Aniket.
Thanks, Jeff. Great to be here. My name is Aniket Ulal. I'm head of ETF research and data at CFRA Research. We are one of the world's largest independent investment research firms, and we support clients both in the wealth and institutional side. So great to be here. Looking forward to the discussion.
Okay, and Francois, hello.
Hi, Jeff. Thank you. My name is Francois Trahan. I wear a couple hats. I publish portfolio strategy research for institutions under the umbrella of Trahan Macro Research. And I'm also involved in this educational platform called the Macro Institute, where we basically teach applied macro and how it applies to financial markets.
Okay, thank you. As you can see, folks, we've got a great panel here. We're going to be able to tackle these questions and topics from a bunch of different angles. And I want to let you know we are taking questions. You can type them into the platform. We'll get to as many as we can. If they're technical questions, somebody will get to you if you're having trouble hearing or something like that. But if you have questions relevant to the conversation, please send them in. At this point, we're looking at the NASDAQ is up about 21% this year. The S&P is up 15%. It's kind of a little bit of a deceptive market, I think. I would like to know what each of you think about how the Fed policy is impacting these financial markets right now. And I'd like to start with Christine.
Yes. Right now, we've had 11 hikes and 7 pauses without a recession. I think that's pretty credible, and I think that's it's exceeded everyone's expectations. We are seeing growth slowing; it is not crashing, stable around 2%. Unemployment also kind of holding firm at 4%. We're not seeing fundamentals meaningfully deteriorate, and we're not seeing any sort of earnings collapse on the horizon. These are all consistent with a late cycle economy. And so it begs the question, the Fed is expected to cut sometime this year based off of their statements last Wednesday. And what it really comes down to is that we are facing a different easing under different conditions. And it definitely this time does feel a little bit different. From our perspective, we're expecting the Fed to cut, and it's going to be a very slow and controlled cutting cycle versus a fast and reactive cutting cycle. Again, market is pricing in one cut sometime this year. We do need subsequent inflation prints to become much more supportive to establish a trend. And so these inflation numbers, as they come out, should open the door for cuts in September. But again, that's completely all data dependent, and the market is depending on that. The average length of time from the final rate hike of a tightening cycle to the first cut of an easing cycle has been historically 8 months. The length of time it's been right now for this cycle has been around 13 to 14 months. So again, like you said, the market is seeing all-time highs. Gold is near all-time highs. Bitcoin is back. Cash is earning 5%. Home prices are still high with no major economic recession or massive job losses to date. And yet consumer sentiment is still down and kind of sour due to the compounding effects of inflation. And so that's kind of where the Fed is right now in terms of where the economy is. But again, a lot more data to expect to see where we can go next.
Yeah, really good stuff there, and a lot to unpack from that. Francois, I want to go to you next on your take on the Fed policy impacting the financial markets. Christine sees a cut coming in September. I like how she laid all that stuff out, like everything is up, 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 but consumers are like, oh man, I don't know, I just spent $10 for a gallon of milk. I don't even know what a gallon of milk costs. I shouldn't have used that. Francois, what's your take on this?
More than it used to, Jeff, is the answer.
Okay.
Well, if you think of what you just described, you described a pretty normal set of conditions for what we see at a peak in the Fed funds rate. And Christina's right, this one has been so far longer than typical. I think the Fed is probably cutting rates in September. What you have to remind yourself is that when the Fed is done raising rates, the economy is usually doing very, very well. It loses a little bit of steam typically in that first year after the end of Fed tightening. It's in years 2 or years 3 that your problems occur. That's when a recession really takes hold. And so in my mind, that's really always been about the story of 2025 and 2026. And so the Fed has told us already that they're data dependent. Leading indicators of employment, I would say the better ones, have softened and are pointing to a higher unemployment rate. We're already at the Fed's year-end target for the unemployment rate at 4%. And so I think they're going to get the data points that they need to cut rates. I think the one place that I would disagree with Christine is I think they will be cutting rates as they normally do. And what I mean by that is aggressively.
Interesting. Annika, what are your thoughts on this? And I mean, is the Fed holding up this market by just promising to cut rates?
Well, we think obviously the Fed is more hawkish now than obviously 3 months ago. 3 months ago, we were talking about potentially 3 cuts this year. I think realistically, we're probably looking at maybe one in December, maybe one in September, most likely just 1 cut in December. Having said that, connecting to where the market is, I agree with a lot of what Christine and Francois said, which is at CFRA, we have a price target for the S&P 500 of about 56.10. So in other words, we expect moderate appreciation. Now that we're in the second year of a bull market, our investment strategist, Stovall, has kind of generally found that great years tend to be followed by good years. And so in the second year of a bull market, you're probably going to have some moderate appreciation. That's kind of where we are right now. I would say on the rates specifically, the reason rates haven't impacted the market is because earnings look strong going forward. We're expecting about 9% EPS growth in 2024, 14% EPS growth for the S&P 500 companies in 2025. That's a pretty healthy baseline. And I think that's what's supporting the market right now. Also, rate cuts are very highly telegraphed. The Fed is very clear about what they're going to do. And so for all of these reasons, we are quite optimistic going forward, despite the fact that we're in a higher for longer kind of regime.
Okay, let's stay with you for a minute, Annika. How healthy is the U.S. economy right now? And in kind of a two-parter here, how do you make the case for cutting interest rates when things are going seemingly so well?
Well, I actually start with taking a look at global growth and global trade, because as you know, a lot of companies in the S&P 500 obviously have international sales, particularly in the technology and some other sectors. If you look at global growth right now, it's stabilized. So we're looking at maybe 2.6 to 2.7% real GDP growth globally. That's still lower than what we had pre-COVID. I think pre-COVID for about 9 years, we were about 3.3%. Growth. A lot of that, of course, driven by China. China is the one that's kind of fallen off. But overall, global growth looks kind of, it's like it's stabilized. It's not falling anymore. On trade, we've seen trade volumes rebounding. Last year, merchandise trade actually fell in terms of by volume. This year, it's actually going to be up about 2% this year, 3% next year. So the basic context is we're kind of stabilizing on the growth front. And I think the Fed is not going to be in a rush to cut rates. That's why I think we probably get one rate cut this year. Is kind of our take on it right now.
Francois, what's your take on the health of the U.S. economy?
Well, I would when Aniket was speaking, it made me think they weren't in a rush to raise rates either. And when they did, we all know what happened, and so the Fed is notorious for not being very good at seeing inflection points, and they're usually late. I would say they over tighten, they over ease, and we get a lot more volatility in the economy than we deserve. I think you got to be careful what you wish for here. Fed rate cuts are not historically good for the stock market. They've been good one time, and that's in the mid-90s, and that's a completely different world than the one we're in today. And so usually the Fed cuts rates because the economy is losing steam, and that's a world where earnings expectations start to turn, and earnings at the end of the day are the lifeblood of the stock market. And so I think a Fed easing cycle is synonymous with a slowing economy, a deceleration in earnings, and a bear market. So I don't share the optimism on where stocks are going.
Why doesn't it seem like, Francois, that the market always likes rate cuts? You're saying the opposite.
Yeah, well, because in the mid-90s, there was something truly unusual that took place. It's the only real soft landing that the Fed has ever been able to engineer. And in 2000, when people were looking back, they look at the mid-90s, they're like, well, if the Fed only cuts rates, everything will be good. And it was the same narrative in 2007. Again, at the end of the day, it boils down to where you think earnings are going. And in the mid-90s, earnings never contracted. It really was a soft landing. And that's the exception. If you look at the last 13 Fed tightening cycles, we're talking all the way back to the 1950s, earnings declined in 12 of the 13 episodes. And so if you're banking on that, mid-90s soft landing experience, you're betting on something that's happened once out of 13 times, or what I call the 8% scenario. It's not impossible. I've seen plenty of things that, had 8% odds that ended up happening. But in my mind, if that's going to be your base case, I feel like you have to have really compelling arguments. And that's what I haven't heard.
Well, couldn't you argue that we're in a soft landing, or at least some people would?
Well, we're at a peak in the Fed funds rate, and we're waiting for the lagged effects of monetary tightening. Remember that it takes about 2 years for a change in the Fed funds rate to show up in the economy itself. And so that first rate hike was in late March of 2022. So we just hit that anniversary recently. We have two data points, basically 2 monthly data points, in that period, if you will. And the unemployment rate is up to 4%. Retail sales disappointing this morning. And so coincident data points look a little different than they used to. So in my mind, we're pretty much on track for what typically occurs here. And I think the Fed will ultimately be surprised by an economy that weakens. It's not their base case scenario. And I think they'll have to cut rates aggressively.
Okay. Christine, let's go to you on this, the health of the economy, and this, the topic we're kind of dancing around, I guess, is the recession. Where is this recession? How do rates go up as aggressively as they did and basically be where they are right now with only a threat of a rate cut and this whole elusive recession?
Yeah, and so I'm with Francois in terms of the probability of the Fed, being on time or late to cut rates. Obviously, it's going to be very data dependent on what the numbers look like. It's interesting because we've been at 5% rates since March of 2023. So even though we've been hiking rates for much longer, we've been at this 5% level for just about over a year. Right. And so it's really, starting to challenge the markets and how long they can sustain this. From our perspective, is that the Fed is going to be inflation first. They're going to be very, very very focused on getting inflation down to their target. So if unemployment ticks up to 4.3, 4.5, if we see growth somewhat tick lower, I think it's going to be in concert with where inflation is, and the Fed is going to actually evaluate if these kind of trade-offs that we see in growth and in unemployment, are those necessary in order to get inflation down. So so it's going to be very very inflation dependent. I mean, all the indicators strongly support that inflation is trending downwards. But again, I think the Fed is primarily inflation first, and it's really going to drive the decision for rate cuts whenever that takes place.
Do you have an outlook for a recession?
We do not.
Do you have any? I mean, is this going to be one of those cycles that avoids a recession?
I mean, like in contrast to Francois's point in terms of rate cutting to indicate, some weakening economy, which I do agree with. However, I kind of, the market is just waiting for rate cuts. They're kind of demanding. They're so over 5% rates, where the point where it's possible where rate cuts will be supportive for equities and also supportive for bonds as well. So it's not we're not as kind of pessimistic, but we would call ourselves cautiously bullish in terms of what rate cuts could mean for both equities and bonds.
Okay, let's talk about the labor market. You mentioned unemployment, Christine. What do you see as kind of we're at the mid-year point of the year essentially. What do you see in the labor market going forward this year?
Yeah, definitely. The unemployment number, we're seeing unemployment really kind of tick up, and the jobs numbers really soften. So we had this huge job number last week, which I definitely don't believe in. I think we're going to see some revisions there in terms of some of the job numbers that we're seeing. But I mean, this is an area that we'll be continually watching. It is continually trending higher. Obviously, there's some more reports that they're going to be more operational efficiencies announced amongst some of the S&P 500 companies. So we see layoffs on the horizon. But however, we're seeing kind of that offset some of the job gains from what I understand is from a little bit of immigration. So a lot of these unemployment numbers are somewhat mixed in terms of what this means for the overall economy. But overall, obviously, we're going to see this number tick up somewhat towards the end of the rest of the year, and it's going to be interesting how inflation and growth kind of come together looking at that.
Do you elaborate on what you mean by you don't really, I guess, believe the numbers in the unemployment rate?
I mean, I think it's been consistent that we've seen revisions downwards in some of the jobs numbers that we've seen. So I think there's I think Francois could speak more about the nitty-gritties on what the job numbers mean, but overall it's just been announced higher than expected and revised downwards based off of new information. So I mean, overall we can take it with a grain of salt, but obviously we want to see how the market digests of the actual true revised numbers when they do come out.
Francois, what is your Christine has deferred to you on your analysis of the labor market. What do you think about that?
Yeah, I'm not so concerned about last month's payroll numbers getting revised. What I'm concerned about is that most of those jobs were part-time jobs or government jobs.
Okay.
And so here's a crazy stat. Full-time employment in the US is actually down from year-ago levels. That's not something that happens when the economy is doing really, really well. When I hear Christine talk about how the unemployment rate goes to 4.3 or 4.5 later this year, the Fed is absolutely focused on inflation right now. We get to 4.3 or 4.5, I think the conversation changes completely, and then it becomes about one thing, which is employment. We trigger the SOM rule, which is this formula that says if you're off the low point in the unemployment rate by a certain amount, you're guaranteed to go into recession. I don't know that you're guaranteed, but I know that the conversation would absolutely change all of a sudden. And so I think we're going to get there. I think we're probably, going to be in that range by the fall. So I think the conversation is going to change dramatically. the very best leading indicators of employment, and I track all of them, but they come from the NFIB database, the National Federation of Independent Business. You know, they have 143,000 members. It's a phenomenal database. It's very granular, but they have one that is hiring intentions, and that leads the unemployment rate almost perfectly. Told you it was going to rise thus far. It's telling you that rise is just going to continue from here. You know, and so I think people are going to be surprised by what ends up happening ultimately.
It doesn't sound like great news. Aniket, what's your take on the labor market?
Well, I mean, I'm glad we have different points of view here. I don't think we're as negative as I don't want to categorize Francois' view as negative, but it's nice to have different points of view. I think, I mean, at the end of the day, softness in unemployment and so on, you know, payroll. I mean, that's part of what's designed to happen when you raise rates, right? In some sense, the Fed is trying to do that and slow the economy down. So I think that that's not surprising. I think ultimately what's driving the market right now is corporate earnings, particularly for mega cap tech companies. I think that's really what's the driving narrative right now around the market. And we are still, if I look at the predictions of our fundamental analysts, these analysts who track Apple, Nvidia, all of these stocks, they have pretty much buy or strong buy ratings on a lot of these stocks. And if you look at 9% EPS growth this year, 14% next year, there's possibilities that the market growth could grow into its current multiple. And so we're not necessarily as bearish or as negative on the market, even despite the macroeconomic conditions. I think, like I said, when you raise rates so quickly, you are going to see this kind of result. If you ask me in a year, I might have a different point of view. Once you're into the third year of a bull market, it becomes harder to sustain. But I think for this year, we're probably going to have a fairly good year that followed a very good 2023.
Okay, let's talk about the strength of the U.S. dollar. I'm going to go back to Christine on this. What's your take on this? Where is this a problem or is this a solution right now? The U.S. dollar.
With the dollar, it's been so far good for U.S. investors. It's been interesting to evaluate the strength of the dollar against the international kind of opportunity set. For right now, for investors who are still clipping away at a 5% yield, the dollar has been king. Cash is king, and it's been interesting to kind of make a case for investors to look elsewhere outside of cash for that opportunity set. In terms of relative to currencies, I really don't have a view much on that, but for U.S. investors, it's been really a discussion with our clients on kind of managing cash and also the prospects of reinvestment risk. So overall, we don't view it as a problem for US-based investors, but potential opportunities for carry trades someplace outside of the US.
Okay, Francois, do you have a take on the US dollar risk or reward?
Yeah, the dollar. Yeah, that. I think your question was really good, Jeff. The dollar is really just the inverse of global economic conditions. And the reason for this is really simple. When the world economy slows, there is less demand for Canadian products. And so the Canadian dollar weakens, South Korean products, the Korean won weakens. You know, every economy around the world is more dependent on exports than we are in the US. And so when the dollar is strong, it's basically just telling you that the world economy is not doing great. So it's an opportunity and a problem at the same time. It helps restrain inflation in the US. We saw import prices last week that were unusually weak while the dollar has been strong. So that makes sense. But again, at the same time, when the dollar is too strong, means the world economy is too weak, you often have something that blows up somewhere around the world, and that can have repercussions for US equities. You might remember the mid 2015 when we had Grexit, when Greece looked like it was about to implode, or in the 1990s, you know, we had the Asian crisis in 97, followed by the Russian default in 98. Those were both periods where the US dollar was quite strong. And so to me, it's kind of a gauge of risk. If I saw the dollar start to weaken sustainably, whether I understand why or not, that would be an indication that the world economy is somehow in recovery mode. And so I would say that it's kind of par for the course considering where we are, but to me, that just highlights risk in the marketplace.
Okay. Annika, what's your take on the dollar?
I have a couple of points I'd like to make. The first is that just given where the central banks are, I think we're going to have a strong dollar for some time, right? Because clearly the Fed is behind the ECB and the Bank of Japan in terms of rate cuts. We just saw ECB cut rates after 5 years, now 25 basis points. The Bank of Japan has moved away from negative interest rates, but still relatively dovish. Just given all of that and given the strength in the US economy, relatively speaking, I think the dollar is going to be strong. I think the question for investors is, particularly those investing in ETFs, is how do you kind of navigate that? I think one thing to really look at is currency hedged ETFs. This is something where there are many markets where it's attractive to invest as a US investor because those economies are export dependent, as Francois said, and so on. Japan is a good example. Obviously, they've got corporate governance reforms as well. But on the other hand, if the yen keeps weakening, then when you translate that back into US dollars, you lose. So currency hedge ETFs really help in that process. If you look at this year at Japan, for example, the iShares Japan ETF is about up 5%. The currency hedged one is up 19%. I mean, looking at a pretty significant differential between these two. And so I think these are products that investors haven't fully always adopted. They have in the past. Last year, it took a while before investors fully adopted currency hedged ETFs. So I think that's something to look at in the context of the dollar.
We got a question from the audience on what you were just saying there, Annika. Are you talking about hedged to local currency or the US dollar?
So essentially what you're doing is you're locking in local currency returns, right? So so two tickers to look at which actually illustrate this are EWJ and HEWJ. If you look at EWJ, which is basically Japan returns, but in US dollar terms, that's up 5.6%, because when you convert back into dollars, you're losing because the dollar has strengthened. Whereas HEWJ, you're getting local currency returns, that's up 19%. And so essentially what the managers do is the identical exposure, identical stocks. In one case, the manager is just layering on a hedge and basically locking in a particular exchange rate. And so you're getting protected from the dollar strengthening. That's really the difference between the two products. So I would say EWJ, there's a whole bunch of other products, but those are just two, which are a nice comparison point because literally the exact same exposure, but one has a currency overlay on top.
Okay, thank you. And thanks for the question. We are getting some questions from the audience. Keep them coming. I want to switch over to the equity markets right now. Are these markets getting too rich? And I mean, to me, I asked that question almost tongue in cheek, because I look at where they are. I've listened to you folks for the first 25 minutes or so, and I think your answer is going to be no. And then I'm looking at this cash on the sidelines, which we're going to get to in a minute. That has to be a rocket booster for the markets. If rates go down, the money has to move and so forth. But let's start with you, Christine. Where do you see the markets right now? If an investor came to you or a financial advisor and said, does it look like this is, too rich to be pouring a ton of money into these markets right now?
Yes, it's definitely a concern. And right now, this is definitely an earnings-driven market. And so if we continue to see strong earnings and growth hold up, then equity markets can stay elevated and stay rich. There are companies that do merit a premium multiple for some of the trailblazing innovation in their industries, and NVIDIA is definitely one of them. And they've definitely dragged the market up with them. And so with those investors who are concerned with, deploying cash at these elevated valuations, you could really barbell these high-reaching PE AI stocks with some of the lower volatility, core, large cap core kind of stocks in low vol to kind of to barbell that exposure. However, with the richness in the equity markets, we're definitely facing a concern of extreme concentration in the markets, and definitely very pronounced in the indexes. I'm sure we've heard XLK is trimming Apple to increase NVIDIA, and these types of rebalances are happening all over the place, right? And also, I think it's really interesting that in terms of contribution to return, NVIDIA has attributed 35% of returns in the S&P 500 year to date. So this means for advisors and clients alike is that there's considerable tracking error by not owning NVIDIA outright in portfolios. And for example, like Apple and Microsoft took 5 years to go from 1 trillion to 3 trillion in market cap. It took NVIDIA only 18 months to reach 3 trillion. So NVIDIA is a stock that it shot up so fast that a lot of clients didn't necessarily get a chance to grab it and own it outright. And so a question has been asked is like, should clients own NVIDIA as a core stock holding in client portfolios alongside the other forever ubiquitous holdings like Apple, Microsoft, and Amazon? And so that's been a conversation we've been having with clients, and and people have been asking, is it too late to get into NVIDIA because stocks are so cheap? This is kind of uncomfortable. And with NVIDIA, we'll definitely expect some pullbacks. In April, we definitely saw something like that. In April, the stock was down over 15% from the end of March to April 19th, which was kind of its low, and it came back and reversed all of its losses. But it comes to show that NVIDIA has become such an important part of the benchmark, where it's contributing 35% of its return of it, that it makes investors vulnerable, much more vulnerable to concentration risk and single headline risk that will basically impact the whole entire index. The market holds its breath every time NVIDIA announces earnings. So if NVIDIA stumbles and it doesn't hit a home run, maybe it hits a triple or a double, the market can have a huge psychological reaction and bring the market down with it. Even though NVIDIA long-term is a quality stock, the market will have short-term reactions based off of what happens with it. So overall, we do expect a decelerated pace of earnings per share growth amongst NVIDIA and on the other Fab 4 stocks. And also we anticipate the rest of the 496 to catch up and see a broadening out of return of growth of EPS growth. So for investors, we definitely be mindful of concentration risk. This is not new to us, but the market does have all their eggs in this NVIDIA basket, and to emphasize diversification and to be positioned for a potential broadening out. And then everything else rally should it occur, especially on the outlook of lower rates.
That's good stuff. I was going to ask, we were going to get into concentration risk, but you basically laid it out, and it makes sense. You can't talk about the equity markets without talking about the Mag 7/Fab 4. Whatever happened to the Mag 7, by the way? We don't talk about that anymore. Annika, what's your take on this? If we're going to talk about the markets being too rich and too risky, we're really talking about just a few stocks, correct? And it's not like there's any other way to talk about it, is there?
Yeah, right now PV on forward earnings, the next 12-month earnings is above 21. So, that's 30% premium to historical average over the last 25 years. So yes, the market is rich. The question is, can it grow into that multiple? And essentially, as I think Christine laid it out well, essentially the market is betting that some of these big mega cap tech stocks like NVIDIA can grow into their multiples. And that's kind of where I think that's the reason the market is up, right? So can it happen? Yes. I mean, again, we are, I would say, still optimistic for at least over the next 12 months. Like I said, we have about 5610 as our target. But that target is very dependent on these big tech stocks hitting the numbers. And I think Christine is exactly right when she says everyone's waiting to see the NVIDIA earnings. So yes, I mean, it is rich. Can we reach that? Can elevated multiples be sustained for some periods of time? Yes, it is possible. So we're still optimistic, but again, it is very dependent on a few stocks kind of hitting the numbers.
Francois, so are we waiting for the rest of the market to catch up to these giant leaders that are carrying everything, or is the risk that these giant leaders stop carrying everything? I mean, or should everybody just start going active management and just buying free stocks right now?
Yeah, I don't know how wise that would be. Look, the market is rich by any measure you can find, but I think Christine said it best. As long as earnings are growing, valuation rarely matters. It's when earnings start to slow and eventually contract that a high PE or a high valuation measure becomes a problem. And historically, once earnings start to go down, lower interest rates no longer drive PEs. PEs only accentuate what is happening to earnings. That's why I said earlier, Fed rate cuts aren't going to save us here. I heard Christine talk about the tracking error with NVIDIA. I remember the exact same conversation in July of 2000 regarding Cisco. The conclusion was we need to own more Cisco in our portfolio. That's a conversation in July of 2000 to reduce our risk. That was the perception at the time. Here's an interesting tidbit. In the second quarter, technology obviously is outperforming. So is utilities. You know when the last time that happened? First quarter of 2000. And so the fact that cyclicals are underperforming, to me, so you're looking at energy, materials, industrials, financials, that's not an endorsement on an economy that's about to accelerate here. If the economy is about to accelerate, we would have the exact opposite leadership. We would see cyclicals that would be leading the charge. Small caps like the Russell 2000 would be on fire, also lagging. Transport stocks also lagging. Those are all signs of an extended bull market. And so I don't see it in the leadership, to be quite honest. I think those are all, like I mentioned earlier, synonymous with a strong dollar, and they're all an underlying sign of risk that is taking place beneath the surface.
Well, on that note, where do you see the markets going from here? There's a question here from the audience. Could we see some weakness during the summer? I mean, it's, lower volume. You get more volatility a lot of times in lower volume markets. I know we're talking about the second half of the year, but what's the next couple of months? Could it flesh some of this stuff out, Francois?
Well, next couple of months, listen, it's hard to forecast the market on a month or two, but my sense is by the time you get to the fall, it's pretty clear that the economy is headed into a slowdown. The unemployment rate has gone up by a couple notches again. I think the Fed's going to be cutting rates. And since they are data dependent and we're already at their year-end target for the unemployment rate, it doesn't take, a lot of bad numbers here for them to completely change their tune. Unfortunately, that comes with weaker earnings, and that's the problem. That's what exposes, lofty valuation at the end of the day. And so, I don't know if this starts next week or next month, but it seems pretty clear to me that a year from now, the S&P is not higher, it's lower.
Okay. Christine, do you have anything to add on that?
Not much to add, but definitely be carefully watching earnings and how I guess overall the market has been gravitating to the mega caps because with the stronger balance sheets and like their cash flows have just been propping up the returns. And so should that stumble, should that slow down, should that soften, I think there will be a reaction from the markets in response to that. Again, it's been investors have been very wary about how long can this party last? Like it could stop on a dime, and momentum has definitely been very pervasive amongst the large caps year to date. And so again, it will be very fixated on earnings along with a lot of the macro numbers Francois talked about. But definitely earnings will drive a lot of investor attitude towards the second half of this year.
Okay.
And can I add something, Jeff?
Yes,
I'm sorry.
Please go ahead.
So what Christine said made me think about something. The S&P is a different animal or index today than it used to be. It's much growthier than it used to be. And the reality is growth stocks don't end a run the way value stocks or cyclical stocks do. Cyclicals tend to erode gradually. Growth stocks tend to hold up because they have these, some sort of structural story to their earnings until they disappoint. And when they do, they completely crack. So, this might have like a longer fuse than typical and end in a bang, to be perfectly honest. I don't know if you remember 2018, but growth was up 20% in the first 9 months of the year, and it gave all of it up in 6 weeks in the fourth quarter. And that was an issue with trade. But again, any disappointment when you have these really lofty valuations, can hit really hard.
But do you see a catalyst for that? Any kind of a
it's called a recession. Yeah. It's a run of the mill, and again, we're only 11 months past that last rate hike. That first year, typically, growth is pretty good. It's in that second and third year that you run into difficulties. And at the end of the day, an economic slowdown is a discovery process. We're going to find out where our problems really are, like subprime in 2008, et cetera. And so I feel like that's all in front of us.
Okay. Aniket, why don't you jump into this conversation? Francois, I know he looked out a year from now, seeing the S&P lower than it is today. What's your take on that?
We think that there could be a pause and a bit of a mini correction in the second half, but we see it as more of a temporary, kind of similar to what we saw in April of this year. Overall, for the next year, we are, I would say, still moderately optimistic. Like I said, we think it's going to be a good year, obviously not another year like 2023. But I think once we get into the third year of the bull market, then of course, it gets harder to sustain. I think some of the issues Francois raised probably more relevant. But right now, we think that we're still on track for a good 2024 with maybe some minor pause, maybe second half of this year. Obviously, it's hard to time it. We don't know exactly, but probably some kind of correction in the second half.
Does any of this conversation that we're having right now make a case for, and I joked earlier about a concentrated active strategy, but in actively managed ETFs or mutual funds versus the indexes? Christine?
Well, really quick, I wanted to kind of address Ankit's point, was that I think it's going to be interesting on whether or not there's going to be any sort of like earnings collapse that could potentially, affect the markets. Right now, we kind of don't see it. It's been the market has already kind of priced in a one rate cut, and so we've kind of seen the reaction from that. So anything outside of that has been will be obviously hurtful for risk assets, but overall, like I mean, it's just been kind of the idea that there is a possibility that there will be a 10% pullback in the markets. That is still on the table, and I think that's normal in any sort of fiscal year or investment year for investors. And so that I think that's still part of the course, and investors should be managing expectations and expecting these minor pullbacks that are short-term in duration. But speaking to what Francois was talking about is that I mean, as we see the numbers deteriorate towards the end of the year, where the 5% rates after considerable amount of over like 18 months is starting to feel into the markets, I'll be quite interested to see if there are going to be certain earnings collapse in the market that we have not already priced in already.
Okay, there's a lot of questions here about the presidential election. I don't know if you folks heard about it, but there's one coming up in November. I'm going to just kind of start ticking these off here. What do you see the S&P and the NASDAQ to continue to rise after the elections? I don't even know how you would answer that question because you don't know what the election results will be. But Francois, I'm gonna go to you because I'm guessing you can navigate that one.
Sure. Well, listen, I'm going to answer it from a fiscal perspective because generally that's really the big question. And the reality right now is whoever's in the White House is going to be inheriting a country that has more debt as a share of GDP than it's ever had, minus, a very short period at the peak of World War II. We have more debt as a share of our economy than we've ever had. We have a larger deficit than we've had certainly going into a downturn. And so, what's going to get said on the campaign, we'll spend this, we'll do that, we'll cut taxes. I think that's all political stuff. At the end of the day, the reality is that there's not going to be a lot of bandwidth to maneuver. I think we're going to be, if we think out through the next cycle, we're going to be at some point living in a world of austerity. I think that's going to become the operative word. I don't know if you remember this. This is like 2 years ago when we had the new prime minister in the UK. And within her first week, she announced tax cuts. And the bond market basically said no. And so, for a developed country, that's a pretty rare phenomenon. You see that, in emerging markets, but for an economy like the UK, for the bond market to say, no, we just can't afford this, and obviously she's, didn't stay in office very long. That's pretty crazy stuff. And so I do wonder, if we're approaching the limits of debt at this point, and if we're 4 years from now in a completely different world. So I don't know that from a fiscal perspective, at least, that it makes a huge difference.
Christine, what's your take on it? There's all kinds of, I don't know, the geopolitical situation in general, and I don't know if I would include a presidential election in geopolitics, but I guess it is. What impact does this have? Or are we just looking at, as Francois said, austerity, no matter who's elected or who is control of Congress?
I think with investors, I think it's mindful to not be surprised if there's going to be higher volatility in the 1 to 2 months leading up to the election. I think that's to be expected. As the markets digest this information and realize maybe a divided government is supportive for business, or this, it doesn't really matter who's in office because business is going to run as usual. I think there's going to be some period of time for information to kind of be absorbed by investors to kind of really interpret what's going on. The thought of austerity is a little frightening, and so that I don't think a lot of investors are willing to kind of go down that path. But the concerns remain the same. I mean, we've been getting asked about concerns about the deficit from investors, and basically what we've been advising our clients is that yes, concerns are real. This is unsustainable. There is a real risk and concern about how the government is going to handle this. However, in the near term, there are not really things actionable that you can actually do to kind of address that at this moment. And so we would advise that these are definitely, 2025, 2026 discussions to have, but we've already have an election really on our plate to kind of deal with. So that's been our message to clients.
Annika, do you want to wade into the political conversation? The impact
I'll just add
of
one
it?
thing, which is we have a group within CFRA called Washington Analysis, which focuses on politics and what's happening in DC. Right now, they project that the Senate is a very high probability the Republicans are going to take the Senate. On the House, they're projecting with a 70% probability that the Democrats will take back the House. And so we're essentially looking at, again, a Congress that's probably going to have different parties. I don't see how that's going to tackle many of the, I think, very relevant issues Francois raised around debt and so on. So having said that, historically, a divided government has not been bad for the market. If you look historically, in fact, the market has done quite well under divided governments. But of course, now, as debt increases and we need structural reform, it's not clear that we may get that in this election because you're going to have, again, two different parties controlling the different parts of Congress.
Okay. All right, we got a question here specifically for Francois, so I'm going to ask it. Do you see a rotation out of mega caps and into value and defensive stocks once the Fab Four lose steam? That's directed to Francois, but we can all answer it.
That's a great question. So what you typically see at a peak in the Fed funds rate, you see this almost all the time, is at some point there is a change in leadership. And so when I look at the second quarter and I see utilities performing better, I see consumer staples performing better, and I see cyclicals lagging, to me that's par for the course for what you see as you're heading into rate cuts and a weaker economy. And so at some point, when we get a weaker economy, unfortunately, these growth stocks that have these lofty multiples, they're in a sweet spot right now for that strategy. But they will disappoint, and that's when they get punished. So what I like, I would say for the next, call it 12 months, is what I call the risk aversion trade. I like treasuries. It's not exciting. It's boring. And believe me, the minute I tell clients about utilities and staples, people start to yawn. But that's the playbook for this type of backdrop as you're going into an economic downturn. And I feel like the market is sending you all of those signals.
Christine, what do you think of that? Is this a time to kind of migrate into defensive value?
Yes, so we've been kind of recommending to our clients the quality theme. You want to have quality everywhere all at once. You want quality in your large caps, which have been continually rewarded year to date. You want quality in your mid cap and small caps. We definitely like fixed income and making sure you're getting, core bond exposure, investment grade, and locking in those yields. And also the investment grade municipal bond scene is also another great kind of quality play or safety play that we could have. And overall, we're positioning our clients for different types of outcomes. If the economy does sour and is trending weaker, like Francois mentioned, we have stuff in portfolios that will continue to serve as a ballast and to kind of be the kind of ballast to quality in a weakening economy. So making sure that clients are neutral and at their target allocation in a lot of these key defensive areas will be definitely beneficial.
Annika, what are your thoughts on that? Should investors start getting a little more cautious, or can they ride these Fab Four for a little longer?
Again, we may have slightly different points of view here, and I think that's good and healthy. My colleague Sam Stovall has done a lot of work on looking at sectors over time, and what he's found is that when you're exiting what was a bad market like we saw in 2022, and you start seeing the rebound like we saw in 23, historically it's been better to let your sector winners ride for some time. And so it's the sectors that kind of bounce back, that kind of give you momentum for some time. We've seen that with IT, we've seen that with technology, we've seen that with communication services. So right at the moment, we're still overweight those sectors. We think it's right now, given where the market is, you want to let your sector winners ride for some time. Eventually, of course, if we do see further weakening in the economy, and we start seeing other signals. I'm not saying that one strategy is relevant forever, right? Things may change, but certainly for now, we're still overweight tech and communication services. But eventually, we will, of course, see a rotation away from growth and into value and into utilities. I do agree, utilities has been kind of the surprise story of this year. One thing is unclear is that driven again by AI? That's the narrative, I think, in the media. I'm not sure that's really the case. I'm not sure the AI is big enough to drive,
Aniket, it's just because they're boring and people need to justify owning them. I think that's the only thing. Let's attach it to AI. It sounds great, and then I can own utilities.
On that I agree with you. I do think that I think that's kind of maybe attaching something sexy to maybe another trend. But at the moment, we're still, like I said, still overweight and kind of letting tech and communication services kind of ride for some time.
I like it. I like that we have some differing opinions here. I want to talk a little bit about cash. We're getting close to time here, but there's cash on the sidelines. We all know that. I don't, I guess it's at elevated levels, and the case for that is pretty darn simple. You can get 5% sitting in cash. This is where I don't understand it. I don't understand how it seems like if rates start to cut, and I know there's differing opinions on how that's going to impact things, but that's got to make risk assets more attractive than sitting in these money market accounts that are just, the yields are going to start dropping. Let's walk through that scenario a little bit, if you will, Francois, how, rate cuts and all the money in cash, and it's so easy to just get 5% right now, but you obviously can't keep up long-term by sitting in cash. So what's your kind of playbook for the cash?
Yeah, so I have a completely different perspective than you do, Jeff, on this one.
Okay.
Rate cuts come because the economy is weakening, and so that is not good for risk assets. They're already, again, take a look at the Russell transport stocks, all cyclicals underperforming, and all of a sudden utilities and staples showing signs of life. And that's as we're, facing an easing cycle at some point, a real Fed pivot. So the one thing that works consistently when you are at this point in the cycle is to buy treasuries. And again, I think the unemployment rate is going to tick higher. I think the conversation on Fed policy is going to change completely, but that's going to become about a weaker economy. That's going to put earnings at risk, and that's the problem for risk assets. That's the opportunity for treasuries. It's not exciting, but to me, if I had cash on hand, that's what I would be doing with it.
Going out on the yield curve?
Yeah. I mean, all of it at the end of the day, I think is going to work out fine. It's going to work out better than equities, any portion of the yield curve. But yes, I think that's the
Really?
way that, yeah.
I like that philosophy, even if I don't agree. Christine, what are your thoughts?
Yeah, I mean, cash is no matter what, it's kind of talking off, a client off a ledge of cash. It's like it's too attractive to walk away from, and you can't ignore it. And so definitely we're having conversations with clients is plan ahead, set aside cash, park your RMDs, cash needs, liquidity needs into T-bills. Like that absolutely makes sense. However, obviously reinvestment risk is a very big part of the discussion where people just don't want to give up this 5% yield. It's okay to hold on to dry powder, especially if you're getting paid for it. So I'm not against that. But however, everything else, you want to get ahead of it now. Step out of cash into bonds. We love treasuries. We love government agencies. Adding duration without the credit risk to lock in these yields is absolutely a no-brainer. And so that's just been the guidance for our clients. We would stay away from high yield. Definitely, you're not getting compensated for what you're getting there. But treasuries, agencies, the spreads are attractive where it makes sense, and adding duration it definitely makes sense, especially now that we are at peak rates. That these are all kind of considerations to cash and planning to have around.
Aniket, where are you on cash is king?
Well, I mean, money market funds were like the story of last year, right? Like I think they took in like 1.2 trillion. That's almost like 2.5 times what ETFs took in aggregate last year. So expectation was coming into this year that money would move off of the sidelines and into equities. I think given that the Fed may cut later now, I think that may not happen. One thing I will say is that it may be worth looking at defined outcome ETFs. I think a lot of issuers created these products to essentially find a way to get investors back out of money market funds and into equities, but by providing some kind of downside cap, some kind of downside protection, being able to take on a little bit, protect your risk a little bit more. To me, that's an interesting category. Is it large enough to maybe suck in all of that, 6 trillion, there's right now over 6 trillion sitting in money market funds. Is it going to take a huge chunk of that? Maybe not. But on the margins, we think that is an interesting product structure that's actually grown quite a lot in the last couple of years. So we would encourage investors to also consider some of those products as potentially ways to kind of get cash off the sidelines.
Okay, we're just about at time here. I'm gonna wrap up with a around the horn question to each of you, and I know it's open ended, so I apologize for that. But I know you're smart people and you can navigate it. What are the risks and opportunities heading into the second half of the year? You can give me one or several. Francois?
Well, the risk is that the economy slows, and that means earnings are under pressure, and the outlook is very different for the stock market than the one that we've been in. The opportunity, as I mentioned earlier, is treasuries. But I would add, since it's open-ended, Jeff, I would add that the difference to me, what makes these markets super interesting compared to the last time the Fed raised rates aggressively going into the GFC, is that you have a lot of products available for retail investors that didn't exist back then. You have factor-based ETFs, you have strategy-based ETFs. And so I feel like there's a lot of ways to protect your portfolio, even under my scenario, and to benefit on an absolute basis outside of just, treasuries.
Okay. Aniket, your take?
Risks, I would say, I would echo what Christine mentioned earlier, which is concentration, the top 10 making up 36% of the S&P 500. I feel like we've already touched on that, so I won't repeat that. On the opportunities, I think emerging markets could be interesting. We talked about elections in the US. but we have had elections in India. We had recently elections in Mexico. I think some of these are economies that could benefit from nearshoring. I think we are going to see longer term trends where companies want to diversify supply chains away from China and other regions to Vietnam, Mexico, India. So I think that's an opportunity longer term for investors.
Okay, and Christine.
Yeah, some of the risks are, like Francois said, slowdown in growth, like that's, or like a surge in inflation, and it results in no cut this year. I think that's going to be devastating for markets. But overall opportunities, core plus bonds, multi-sector bonds. I like PYLD, which is the PIMCO Income ETF, and MINO, which is the PIMCO Muni Strategic Opportunities ETF. Like I'd like definitely buffered ETFs or defined outcome ETFs. That definitely makes sense. And opportunities away from stocks that have already run, especially in the low volatility area. Even though concentration has been rewarded in the near term, keep in mind diversification does play a role in portfolios in the long term for long-term investors.
Okay. On that, we're gonna wrap it up. I want to thank Christine Sol, Aniket Ulal, and Francois Trahan. Really, really good questions, folks. Thank you, the audience. Great answers. I know I learned a lot. I'm looking forward to the second half of the year. Hoping we don't get into some kind of a funky recession or something like that. But all you can do is do your best. This is going to be posted at ETF.com if you want to go and check it out there. I'll probably be there tomorrow, maybe the next day. Also, go to ETF.com and check out our advisor center. There's a lot of stuff there. It's all for financial advisors. We're building it up and building it out and looking for feedback from you folks to help us do that. On behalf of ETF.com, I'm Jeff Benjamin, and thank you for participating and listening.